You buy the house, you sign the mortgage, and the question doesn't go away, it repeats. Should every extra dollar go toward killing the loan, or should it be invested and left to compound? The outcome most people expect is clarity. What actually happens is friction, a 300,000 balance, maybe 500,000. Each month, a payment goes out, most of it absorbed by interest, while the balance barely moves. Progress feels slow. Meanwhile, someone close to you talks about market gains, like the answer is obvious. The issue isn't discipline or intelligence. It's the structure of the decision itself. A mortgage quietly reshapes cash flow long before it changes net worth. If left unexamined, it keeps producing the same tension month after month, regardless of income or effort. I'm Alex. Today we'll look at this decision through three clear frames: investing the excess, aggressively prepaying the loan, and a third structure I call the F-square rule, or freedom fund, moving from surface math to the constraints that actually govern behavior. That starts with understanding what the mortgage is already doing to your money before you make a single extra move. Baseline mortgage scenario. A 30-year mortgage sounds abstract until the first few payments clear your bank account. $500,000 at 7% doesn't feel theoretical when the monthly payment lands at roughly $3,300 every single month before taxes, insurance, or maintenance. That payment looks manageable on paper. It usually is. That's why most people stop thinking about it right there. Then something changes. A promotion. A side project that finally pays. An extra $1,000 a month shows up that wasn't there before. Not a windfall. Just enough to matter. And that's when the decision quietly appears. If you add that $1,000 to your mortgage payment, nothing in your lifestyle changes. Same house, same driveway, same neighbors. The only visible difference is a smaller number on a statement most people never read. If you invest it instead, the money feels alive. You can see balances move. You can track progress. You can imagine future versions of yourself using it. But here's the part most people miss early on. In the first year of a loan like this, you send the bank close to $40,000. The balance barely moves. After 12 months, you still owe around $496,000. That gap between effort and progress is not an accident. It's the structure. So before choosing speed or growth, before spreadsheets or opinions, you need to understand what this loan is actually doing to your cash flow, while everything still feels normal. Scenario 1, invest the extra cash. Investing the extra $1,000 feels clean and modern. You automate it, forget about it, and let the market do the work. Month 13. The transfers begin. $1,000 flows into a broad market index fund, then slightly more each year as income rises. Nothing dramatic, just consistency. Historically, the stock market has returned about 10% annually over long periods. To stay grounded, assume 9%. That already accounts for fees, taxes, and bad years. With a modest 3% annual increase in contributions, that steady stream compounds quietly in the background for the remaining 29 years of the mortgage. Run the numbers, and the outcome looks almost unfair. That one decision grows into roughly $1.8 million. Not a jackpot. A result. Enough to fund retirement. Enough to create options. On paper, it dwarfs anything mortgage prepayment appears to offer. And the logic is seductive. Why rush to kill a loan at 7% when your investments might earn more? Why lock money inside walls you can't sell piece by piece? The account balance moves. Progress is visible. The feedback loop feels rewarding. But there's a subtle assumption baked into this path. It assumes the market cooperates early, not just eventually. It assumes patience feels the same in year 2 as it does in year 20. And it assumes you won't touch that money when life applies pressure. Those assumptions don't break the math, but they do shape the outcome. Mortgage amortization reality. Most homeowners think their monthly payment steadily chips away at the loan. That's not how this works. In the early years, the mortgage behaves more like rent, with paperwork attached. You pay faithfully, but ownership barely moves. On a $500,000 loan at 7%, the first payment is roughly $3,300. Almost $3,000 of that goes straight to interest. Only about $400 reduces the balance. 12 months later, the numbers barely improve. You've sent the bank close to $39,000 in year 1, yet the loan is still sitting around $496,000. Even 5 years in more than 2/3 of each payment is still interest. It takes over 20 years before principal finally overtakes interest in a single monthly payment. That isn't a flaw. It's the design. The bank collects the most valuable dollars upfront when your loan balance is highest, and inflation hasn't had time to do its work. This is why extra principal payments feel unusually powerful early on. A dollar of prepayment bypasses the interest funnel completely. It goes straight to the balance where time can no longer tax it. And this is where the decision starts to change shape. One path depends on markets behaving well over decades. The other rewrites the math of the loan immediately. Same $1,000. Very different leverage. A quiet fork in the road. Pause for a moment and imagine this scenario clearly. Your income increases by $1,000 a month. Same mortgage, same market, same life. Just extra room in the budget. Where does that money go first? Option A, you invest all of it. The logic is clean. Higher expected returns. Long-term growth, let time and compounding do the work. Option B, you send every dollar to the mortgage. No excitement, just a smaller balance and fewer years attached to it. Option C, you split it. Part toward investing, part toward reducing the loan, letting both move forward at the same time. None of these choices is a mistake, but each one exposes what you're optimizing for. Option A prioritizes upside and flexibility. Option B prioritizes certainty and reduced pressure. Option C prioritizes balance and behavioral durability. Most people assume this is a math problem. It's not. It's a stress test. The choice you lean toward reveals whether growth safety or stability feels most scarce in your life right now. Hold on to that instinct, because the next path we're about to examine takes the least exciting option on paper and shows why it quietly changes the structure of everything that comes after. Scenario 2, aggressive mortgage prepayment. Apply that extra $1,000 directly to the mortgage, and the effect is immediate even if it doesn't feel exciting. Unlike your regular payment, none of it leaks into interest. Every dollar goes straight to principal. The balance drops faster than the schedule ever intended. On the same $500,000 loan at 7%, adding an extra $1,000 per month starting in year 2 changes everything. Increase that payment by 3% each year, just like income tends to rise, and the 30-year mortgage collapses into a little over 16 years. Nearly 14 years disappear. The interest bill tells the real story. Without prepayment, total interest approaches $700,000. With aggressive prepayment, it falls to roughly $318,000. That's a reduction of about $380,000 in interest alone. But this isn't free. Over those years, you send about $238,000 in extra payments to make it happen. Subtract that, and the true financial gain is closer to $142,000. Meaningful, but not life-changing on its own. What does change is the timeline. Suddenly your 40s or early 50s include a house with no monthly payment, no leverage, no obligation. The math looks smaller than investing, but the shift in control is larger than it appears. Prepay then invest outcome. Here's the part that rarely gets modeled correctly. When the mortgage disappears early, the cash flow doesn't vanish with it. It changes hands. The payment that once serviced debt becomes investable fuel. In this case, once the loan is paid off around month 196, the full monthly obligation opens up. The original $3,300 plus the extra $1,000 you were already committing. Roughly $4,300 per month is now free. Instead of celebrating and spending it, assume that money gets invested consistently for the remaining 13 to 14 years of the original mortgage timeline. Same assumptions, 9% returns, no heroics, just repetition. That stream alone grows to about $1.18 million by the 30-year mark. Add back the net interest savings from prepaying roughly $142,000, and the total lands around $1.33 million. Compared to investing from the start, it's lower. Not by a little, but not by an order of magnitude either. And the path feels very different along the way. Fewer market swings early. No mortgage payment later. This outcome doesn't win the spreadsheet contest. What it buys instead is time. Time without fixed housing costs. Time where income has fewer claims on it. And that trade-off is easier to appreciate once the house is already yours. Sequence of returns risk. The projections so far assume a smooth 9% every year. Real markets don't work that way. Returns arrive unevenly, and the order matters more than most people realize. Consider two investors who both contribute $1,000 a month for 8 years. One starts in late 2007, right before the financial crisis. The other starts in early 2009 near the bottom. Same discipline, same dollar amounts, same market. 8 years later, the first investor averages roughly 4.5% annually. The second clears more than 17%. Nothing about their behavior changed. Timing did. That difference is sequence of returns risk. Early losses do more damage than later ones because they hit when balances are small, and confidence is fragile. You're adding money while watching it fall. That's when people pause contributions, change strategies, or abandon the plan entirely. Mortgage prepayment doesn't have that problem. A dollar sent to principal earns the same return every time. 7% locked in, no volatility, no headlines, no waiting for recovery. This doesn't make investing bad. It makes it conditional. The math only holds if you stay invested through the worst years, not just the good ones. And that's where spreadsheets stop being helpful and behavior starts deciding outcomes. Guaranteed return and tax differences. There's a quiet comparison hiding underneath all of this. Paying down a mortgage is not just debt reduction. It's an investment with a fixed return. If your rate is 7%, every extra dollar sent to principal earns exactly 7%. Not on average, not over time, immediately, and it never has a down year. Put that next to the alternatives. High-yield savings hover around 4 to 5%. 10-year treasuries sit near the mid-4s. Corporate bonds might touch 6 if you accept default risk. A guaranteed 7% starts looking less boring when you line it up honestly. Taxes tilt the scale further. Investment gains are eventually taxed. Even long-term capital gains take a slice when you sell. That 1.8 million headline number isn't what you keep. A portion belongs to the IRS and the timing is outside your control. Mortgage interest you don't pay is different. The savings never show up as income. There's no form, no line item. The money simply stays yours, quietly, permanently. This is why two people with identical net worths can feel very different about their finances. One depends on markets continuing to cooperate. The other has permanently lowered their cost of living. Same math on paper, very different margin in real life. Scenario 3, the F-squared rule. This is where the false choice falls apart. Instead of forcing a decision between growth and certainty, the strategy gives the extra cash 2 jobs at once. That balance is what I call the F-squared rule, short for freedom fund. The idea is simple. Every extra dollar should either expand future options or reduce fixed obligations. So you split the 1,000. 500 goes into long-term investing. 500 goes straight to principal. Both increase gradually as income rises. Nothing aggressive, nothing fragile. Even at half strength, the prepayment side still reshapes the loan. The mortgage ends roughly 9 years early. Total interest drops by about $200,000, and after accounting for the extra payments, the net gain lands near $79,000. It's not dramatic, but it's permanent. The investment side compounds in parallel. $500 a month stepped up annually grows to roughly $840,000. Then the quiet shift happens. Once the house is paid off, the full mortgage payment becomes available again. Over $3,800 a month flows into investments for the final stretch. That second phase adds roughly $460,000 more. Combined, the outcome lands near $1.38 million. Not the maximum possible, but built with less pressure, fewer assumptions, and far more tolerance for real life. Decision filters and personal optimization. This is where the math stops being universal. The same numbers lead to different answers depending on what pressure you're actually under. If you're carrying any debt above 10% credit cards, personal loans, the decision is already made. Paying that down beats any reasonable market expectation. No discipline required, no patience test. Just removal of drag. If retirement is within 10 years, a paid-off house changes the equation entirely. Your required income drops. Your portfolio doesn't need to work as hard. Volatility becomes less threatening when housing is no longer part of the monthly equation. Job stability matters more than optimism. If income feels fragile, reducing fixed payments increases margin immediately. You can't cover a mortgage with unrealized gains during a downturn. On the other side, very low mortgage rates flip the logic. A 3% loan behaves like subsidized capital once inflation is considered. In that case, liquidity and invested assets buy flexibility that equity cannot. Emergency reserves come first. 6 to 12 months of cash isn't conservative. It's operational. Without it, both investing and prepaying become brittle. And then there's the part spreadsheets can't measure. Some people feel trapped by debt. Others feel trapped by illiquidity. Same balance sheet, completely different stress profile. The optimal choice isn't about maximizing dollars. It's about minimizing fragility while preserving options. That's the lens that keeps working long after the numbers fade. Key takeaways. The question was never really about beating the market or killing a mortgage as fast as possible. It was about understanding which risks you're choosing to live with. Investing favors long-term growth, but depends heavily on timing behavior and emotional tolerance during downturns. Mortgage prepayment trades upside for certainty, lowering fixed costs and shrinking the margin for error in everyday life. The F2 rule sits between those extremes, not as a compromise, but as a way to keep both progress and resilience moving together. What matters most is not the final number on a spreadsheet, but how stable your system feels when income pauses, markets fall, or priorities change. Financial freedom isn't a finish line. It's having enough margin to absorb shocks without being forced into bad decisions. If you're thinking about money this way through structure, risk, and flexibility, you're already playing a longer, calmer game than most.